Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. My purpose is to help you make your dreams a reality. These ongoing videos are about using our closed-end fund investment strategy. If you want the full methodology and our 12 steps to financial freedom, then head over to Facebook and check out my page there called Adaptive Perspective, Navigate Your Finances, where I give you the entire framework for free. Um, First, some reminders and then some disclaimers. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial strategist. I am not a financial advisor. Raw video, you get all the errors. I am not a financial advisor. I am a financial strategist. And I don't speak like the herd. I walk in limited company and sometimes I walk alone. And the extra disclaimer for the day. This is the second time I've made this video. So this is now 2 hours after I made the first one. So I'm more tired and a lot more snarkier. And um, still not thrilled at the Microsoft platform. It's a lot cheaper than Apple for a reason. So last week's video ran super long because there was a lot to discuss as we strategize in the here and now and play the long game. And this week, I'm hopefully gonna trim things up. And I'm gonna really trim things up because this is the second time through. So instead of me saying the same exact thing that I said last video, or a ton of stuff similar to the last video, I don't want to just keep repeating the same thing. So if I can trim a lot of that down and get to the more meat of things, why do I like closed-end funds? I like discounts. Nobody wants to pay full price, right? Some people will pay the face value of something if there's a really good reason for it, but who doesn't want a discount? So not only the discount, but you get amazing 8% plus dividends. Our target has been 9, unless you've got a really good reason to not pursue 9, but 8% plus dividends. I think the average across all 417 current closed-end funds is 8.3. You get opportunities across every sector. Now, you can search out the portfolios in a can, those guys who invest in a little bit of everything. But if you want energy, if you want technology, if you want bonds, if you want this or that or the other, you can allow this closed-end fund director to buy all of these things. Like if you want technology, you could look at Microsoft, Nvidia, Apple, Amazon, Google, Facebook, or Meta, Monolith, uh, Tractor Supply. I mean, like you can let this manager buy all of this stuff, and instead of you buying every single stock, you're just getting access to every single stock through this one investment into a closed-end fund, right? And because you get all of this access for a single investment, it's really low risk compared to that single stock investment, right? Instead of us buying Exxon, Shell, this, that, the other, I can buy just one fund like KYM, where I get access to a lot of oil companies, a lot of energy transfer companies, and I don't have to buy everything. It's just one fund. You get improved upside. So since you're buying the discount and since we're buying historic discounts, you're getting this wide open window of a discount. So as the price starts to close and as the discount window closes and the price goes up, you're getting that improved upside. Now, we're not necessarily selling when the discount window closes. We're collecting consistent dividends, growth over time with the goal to retire on dividends. So outside of a few funds that we will sell at specific points, we're not looking to sell everything. And in that, you get a varied strategy. So whether you're in an individual brokerage account, which that's where we started. If you have a traditional IRA, if you have a Roth IRA, we have one of those now. Regardless of your overall apparatus, you can still own closed-end funds, but inside of that, you can buy and hold. Like I'm going to buy it and never sell it. I'll let my inheritors sell my funds. You can swing invest where not what it maybe sounds like, but you can buy something let it escalate and call, or let the price point improve, and then sell that high, and then push your money forward into another investment. Or you can kind of do both. But as for the market at large, it hasn't changed much. So instead of rehashing everything from last week, I'm going to skip a lot. Um, like I'm going to skip a lot, and I'll get into this on the next video more, because it won't be the same exact thing I said uh, week to week. So skipping a lot of the stuff I covered last week about the economy at large, I I think we have to acknowledge kind of the overall mindset of the market. As my uncle Art says, the market looks forward. And Brett Owens would say it moves like a stumbling toddler. And if I twist both of those, it reads like this. The market always looks forward like a stumbling toddler. It'll make progress towards that shiny toy, but it's also going to stumble, fall flat, land on you, and cry at times along the way. And when it lands on you, sometimes it doesn't bother. Like maybe it falls into your lap, like you want a toddler to do. Maybe it hits you in the groin, which doesn't feel good. Or maybe they bang heads on your kneecap, which still doesn't feel good, but it's still moving forward all the time. So all I'm saying is that we buy the best deals for now with the long-term game in mind. Even when that long-term game includes a lot of doom and gloom, because everybody's going to say doom and gloom at some point, and includes those ups and downs, like getting head butted in the nuts. So, what's the long game strategy? We adhere to the strategy unless you have a damn good reason to not adhere to it. It's like what Barbosa says in Pirates of the Caribbean. The code is more like what you'd call guidelines than actual rules. So, here's where we stand. What's the code? I mean, I run a nautical based I run a nautical metaphor based company, Navigate Your Finances, right? Or I guess overall page, Navigate Your Finances on Facebook. Adaptive perspective, where we're always looking at where we are and where we want to go, and it's related to an overall map. So, yeah, here's the code. We buy historic discounts, which means you have to do your homework or you let me do the work for you. We focus on consistent and rising dividend payers. So when and how those dividends get paid matters. One, like can the company cover them, but also when they happen matters. So do you want monthly payers or do you want another setup? And there's quarterly, there's kind of an alternating cycle. Some people pay twice a year, not my jam. Some people pay once a year, not my jam. Lately, we've been pursuing monthly payers, but we do still have a couple quarterly payers in the individual brokerage account. You want to be mindful of the dividend yield, right? Our focus has been 9%, unless there's a really good reason to buy something that's paying a little bit less. And then we use all that grander scheme data that I didn't get into this week because I said the same thing last week. And quite honestly, I said it again on a longer video, and it's not my goal to make a longer video. So you have to know your focus, you have to know your strategy, and you have to be willing to move away from the herd. In the end, you make the calls on which funds to buy. I'm presenting our info and our rationale, and I'm showing what we buy. And yes, those are the real portfolios I'm showing. Maybe that you haven't seen yet, but if you watch past videos, those are the real portfolios. And I'm not here to take your money and invest it for you. To be completely transparent, my end goal is to market this list and make a paid for community for complete access to the list. So everything I'm showing by video, you would just have access to, right? But I'm not there yet. So when I reach that point, I still plan to make the videos because these videos challenge me to rationally explain the process of picking funds. And it goes back to the reality or the concept that if you cannot explain your strategy or rationale, then it's probably not a good idea to pursue, or you need to get a lot better at communicating. So whatever it is whatever your strategy is, it's great that you understand it. You should be able to explain it to somebody else and have somebody else reply to you with, I understand what you're saying, but I don't get it. And that's fine. You don't have to agree on everything, but you should be able to explain your strategy to somebody else and have somebody else understand what you're saying, right? And that confirms that you've communicated it well. So you either need to get better at talking with people or you need to get better at strategizing, maybe both. So whether a paid for community or now, my goals remain the same. I'm here to help you make your dreams a reality and to help you. I talk about investing and general financial strategy on YouTube, and then I detail out our 12-step system on Facebook and walk you through that system in a completely free group. So regardless of platform, I want to help you form your strategy and build your confidence to self-invest toward your financial freedom goals. It's so much easier to do all of this. Like, pick your platform. It's so much easier to take on managing your money as well as different ways to invest your money and market investments. It's so much easier to do this than any wealth manager I've ever talked with. You just have to be willing to do some research and put in a little time. But like a lot of people, maybe you're short on time. But that's where I come in. So use my work to help your goals. I'm doing all this work for us and our goals. I've got all this data, all the closed-end fund data, all the explanations and rationales. So just add me to your list of trusted resources and factor my information into your strategies. So let's look at where the bargains are for the week and then see how we can make the best decisions for the short and the long term. All right. So this is the closed-end fund master list. Um, I update this list frequently. Um, if it's in purple, mid blue, green, or light blue, it gets updated weekly. The entire spreadsheet gets updated monthly. Um, and there's a lot of funds. So how do we differentiate? We look at the historical data for each fund. So a triple asterisk is a buy alert for that one fund. Two asterisks would be dollar cost average based on what we already own. One is for tracking for any number of reasons. So everything is currently listed in alpha. So we're going to list by discount and then by target. Now we're going to take this data, and I get it's minuscule, but I took a screenshot. So I get it's minuscule, but it'll change. We're going to put it here. Current means we already own it. And our focuses are these. So we're by target. So let's scale it based on payment. Our goal is monthly payers. Next, we want to look at the overall yield. They're all significant discounts, right? So we don't have to sort that. They all pay monthly. So now we look at yield. Now, follow the code unless you have a really good reason to not follow the code. HFRO remains the biggest discount along with their sister company, HCLB. And I don't exactly know why. I think the fears are oversold on HFRO that they're making their payments, that they have a lot of investments coming up, coming online that will hit like their developing properties that will come, however you want to say, come available or also just begin operating and bringing in money in the next 1 to 3 years. So I think the fears are oversold. Now they are invested in a lot of their own product. Um, And I don't get the discount on their sister fund. They both decreased their dividends this year. Um, the HFRO cut their dividend in half. HELB cut it a little bit. Um, but they're still well-run companies. Um, so if we're buying the discount, so if you're putting $1 in, and I don't know if there's a break even, there are up there too. So if you're putting $1 in, for every dollar invested, you're paying $1 for these two funds. If you're so for every dollar invested, you're paying, let's look for another round number. You're paying 105 for this. At 5% at 5% premium, you're paying 105 for that, right? But for every dollar invested, you're paying 43 cents for access to $1 billion in real estate. And real estate that's not fully developed, things that are still in process, still in the works, things that are not completely online, up and running yet. So it's really hard to look past, even though it doesn't hit the 9% metric. The other is this one. Um, it's the mix. It's stocks, bonds, and some other stuff. And it is all real estate related. Um, RFI's invested into the companies that we want to be invested in. You've got this huge, giant push for technology. And then you have this huge, giant push to connect everything that's just going to draw just way on the power sector and the overall energy sector. So RFI is invested into not so much that they own American Tower and Crown Castle. Uh, American Tower and Crown Castle own the spaces that cell phone companies rent in order to transfer data, and RFI is invested into those companies. So instead of investing into outright technology, semiconductor companies, pick your cell phone carrier, they're invested into the middle group that's going to need all that technology and communicates all that data to somebody else. Like you can invest in technology all you want, but if you don't have a tower to transfer the data, then it doesn't matter. So I get that it's not, same thing, I get that it's not a 9% yield, but they've got the right investments, one. And two, in a lower rate market, they have been known to pay a special dividend. So their last special dividend, which was not this year's in 2022, was this. And that changes the game considerably. So it would stay. So we can get rid of these. Now, if we were looking into the individual, I could argue for the municipal funds since those are tax free. But this is for the Roth and it's already tax free. Apologize, my allergies just spike at night. We get rid of these. Now, this one, same thing. It's a bonds idea. Um, I'll scroll this out so you can pause it and read it. It doesn't hit the 9%, but it's close. But it's got consistent income. Um, so I'll leave it on the list for now. What won't make the list? We're not. See how to say this. I read Michael Foster, The Contrarian Outlook. It's like the labor data isn't as bad as it's spinning. Maybe stocks are a good place to be, but with Brett Owens, maybe not with Brett Owens, but with our strategy falls more in line with Brett Owens. Bonds are the go-to at the moment. So if you look at bonds and loans, which kind of cross over, and then loans and real estate, which also kind of cross over, even though bonds and real estate are not the same things. Um, that's our focus. And that higher for longer really just sounds, I mean, nobody wants higher for longer interest rates. Every corner of the market would do well with an interest rate cut, but higher for longer will help the fixed income guys. And you're not going to see that in real estate, but in bonds, you'll see that. And if you've never heard income, or you're kind of curious about what it is, if you go to Investopedia and just type in fixed income, it'll give you the whole spiel on fixed income. So of our targets, like we're looking at bonds, loans, and real estate, not oil, technology, and the rest, and single stocks. So to target bonds, loans, and real estate, and then also factor in fixed income, that really just makes it bonds and loans. And real estate, if we can afford it, or real estate if we have the cash on hand to buy it. So using that, we filter out the rest of the list. So all stocks are going away. SABA, same fund owns SABA and BRW. And from looking at their portfolios, BRW gives us better access. NBXG is all, gosh, it's all technology, but technology's high. And that's where the hurt is. And I don't want to, I want to be in that smaller area of the market where the herd is avoiding and the prices are better. This company is a term fund. Um, it's on it's on renewable energy, but all of those things require oil in order to function and in order to be made. So I just have not been able to convince myself that it's a good thing for us. Let's see, all stocks. If you are in the crowd that thinks a foreign investment is better than a US dollar investment because the Fed is devaluing the US dollar, then maybe this is a place for you. Um, on the current strategy for us, they only have one bond holding. Otherwise, it's stocks. So that doesn't fit our metric. I don't know enough about this company. I mean, honestly, it's the listing gets updated sometimes almost daily. Uh, but I need to continue updating because I have not updated every single green colored fund. I will say this: we are not in the crowd who will diversify just to diversify. That's a Warren Buffett thing. Um, do not diversify just to diversify. I mean, go into the market knowing what you want to invest in, but don't just spread your money around into more of the same just to decrease and diminish your risk or improve your access. Uh, if we're looking at outright bonds, we've got an almost $2 billion now, $2 billion asset company. We've got a 33 million right on the polar opposite end of things, all bonds. They've got a small part of bonds. They've got a lot of bonds. I don't need another bond company. And that goes for NPCT as well. And then this one is a catch-all. And it just doesn't hit our focus right now. So that leaves us with this: a group of funds that we already own inside the Roth, plus another one. Um, so what we did last week is this: we invested into mostly bonds and real estate. So you get bonds, a mix of, so here, I'll let you read as you go. But that's my cat in the background. Bonds, some bonds, corporate bonds, corporate bonds, all real estate, um, with that hidden yields potential, and then all real estate. So this company tends to swing in that their price curve seems to follow the overall rate curve. So if we pull back into the grand scheme of things, it has bouncing moments. And at sub $2, I'm willing to play the bounce. The lowest it's ever gone, yeah, was the original housing crash down to like almost $1. But in recent memory, $1.50. Um, yeah. If you want the actual full report on their portfolio, you have to go to the website. Um, CEF Connect has a limited snapshot. Even Morningstar has a limited snapshot. But what they are overloaded in is fixed income, as is FCO. So as we look at where we want to go this week, if I can move this, and of what we already have, we don't want any of that. In a perfect world, we would buy all of it. But the one I could kind of counter against is this one because it goes with that whole idea of like we're already invested in a lot of bond companies. So unless this one gave us just a lot of different access, which I get what Mike or Foster's saying, but at the same time, if that gave us a lot different access than what we already had, I would consider it. But that comes down to me like splicing needles, and it's just not going to make the long term. So that leaves us with things that we already have, and that we own all of these funds inside the Roth. So in a perfect world, yes, we would probably buy another 50 spot Evolve, but we don't live in a perfect world, and we only have so much money. My goal last week was to leave a residual so that we could take the residual amount plus the dividends for this month and then carry that forward and maybe pick up another 50 spot or 100 spot of something. And based on this list, so we're getting, well, here, this is the portfolio. Pause it if you need to. So we're getting about that per period, which might still be a little less based on when we bought things. So that was May. June ought to be similar. Okay, so we'll say about $68 difference. That puts us around 190 plus added cash. Um, Webull pays like a 5% yield, I think, on just general um, cash in your account. So for 200-ish, based on this metric, I like to buy things in sets of 50. There's really only one company we could buy another spot of, but that's okay. So if we bought this week, which we're not, uh, if we bought this week, but we're not, we would buy this because just read the description. It hits the metrics. It also hits our available funds. So it hits our available funds. One, it pays greater than that 9%. It, but even like if we factor the 9% out, so it hits in our available funds. It is all bonds. It has a really high amount of fixed income, which will do great in that higher for longer scenario. It happens to be super small, which means we can just buy more of it. And it just happens to pay a little north of 10%. That's a really good deal. So if we bought this week, that's what we would buy. And as a remainder, so if you do the math, we take that cell minus that cell equals that. And at 90 some odd dollars a month, if it really came down to it, we could pick up another 100 spots so long as it stayed at the same levels. So in on that bounce pattern, it, that would be the one fund that I would consider selling on that bounce. Like everything else in here is marked really for a lifetime. Like it's a buy and hold. Like this company doesn't go on sale much. So even when it goes briefly on sale for something just minuscule, we buy it. Same thing for RFI. Um, but it doesn't go on sale much. So you buy it when you can. Versus this one seems to go in that maybe not a roller coaster pattern, but that right up and down pattern. So it just kind of depends on what you want to do with that up and down. Either you're buying the down and holding it through the pattern, or you're buying the down and selling it high and then rolling that money or pushing that money forward into something else. And the added benefit of the Roth is so long as you jump through the hoops, there are no taxes. It's not tax deferred. There are no taxes. So it's the weirdest. I mean, you're limited on contribution. Current contribution's like 7 grand a year. Uh, but so long as you stay on the parameters, I mean, you can sell a ton of stock, have a ton of profit, and carry it all forward, and there are no taxes. Very unique thing. Very unique system that I wish I knew about 20 years ago. But that's hindsight. So in the here and now, this is what I got. Any of these fit the model. I mean, I get it. These are not that 9%, but that's the follow the code unless you have a good reason not to, and those would be a good reason not to. All of them hit the historic discount targets. All of them are monthly, right? We've already talked about yield, and they all hit the focus between bonds, loans, and real estate. So it really comes down to your individual strategy. If we bought, we would buy CIF, but quite honestly, we're not going to buy next week. Um, I don't know when we'll buy again. I don't plan on buying next week, but if the price dipped, I mean, if the price dipped to that 1.5 low, um, that would be a good time to buy, pending the discount was still a historic discount. So that's all I got. Um, if you like the content, consider subscribing to my channel. Hit the like button because it really does push videos out. And then head over to Facebook and check out my group there called Navigate Your Finances. Um, I say this every video, and if you're new and it's confusing, give me some grace. So if it's new and confusing, check out my group on Facebook. I explain things regarding the ship metaphors there, but you're the captain of that ship, and it will go wherever you steer it. If you know where you are, it's quite easier to get to where you want to go, right? Gives you a purpose, gives you a goal, gives you a mindset. And it becomes your job to figure out how to go from point A to point B, right? But whatever you want, whatever dreams are there, whatever financial freedom goals you have in sight, none of those things will happen on their own. Like if it could have happened on its own, it would have happened on its own, but it hasn't. So you got to make it happen, which just means you have to do something about it. I can't do it for you. Your neighbor can't do it for you. You have to do something if you want a completely different life than what you have right now, then you must do things that will allow you to have that other life, right? So make your dreams happen, right? Captain your ship, lead your crew, and get your boat from point A to point B. So whatever you have for the week, hope it goes well. If you have no idea what I'm talking about, if all of this is confusing and weird, head over to Facebook and check out my group there. And hopefully that explains things a little bit better. And then if you still have questions, by all means, ask. If you have comments or questions about closed-end funds, add those. Always happy to discuss, comment, and strategize on closed-end funds. So hope y'all have a great week. See y'all on another video. Bye-bye.